Well, we're seeing amazing kind of migration from the Mag 7, which is the Microsofts of the world, the Metas, um, these companies, that the capital is leaving those companies and going into more value equities, international equities. And so the market's actually been broadening out a little bit, and was extremely concentrated in a few names. And this is the beginning of a large process. But international equities, since the fourth quarter, are destroying the S&P. So I would say this: we had an ideas dinner in December in Palm Beach, and when I hear three really famous institutional investors saying the same thing, and the point they made to me is this: when you see global value, so large cap equities that are outside the United States, doubling the performance of the S&P last year, and then this year also much, literally 5 to 10, 20% greater than the S&P this year, emerging markets, global value. This is the beginning of a multi-year trend. It's not something you see in 1 year as a blip. That's the main message that I'm getting from a lot of our institutions around the world. And so global value, you want to kind of take down your US exposure and move that toward the rest of the world.
Very interesting. Talking about the stock market, I have to ask you this question because I think many of our viewers would be really interested to hear your thoughts on this. So AI stocks make up about 30% of S&P 500, and many are worried now that an AI bubble that's related to surging valuations, as well as probably it would be safe to say speculation on unproven startups, will sort of cause a lot of trouble down the road. So, what are your thoughts on the possibility of there being an AI bubble? And if you believe that there is, what could be a potential aftermath in the worst case scenario?
Well, today Microsoft's off about 10%. And we went back and we said, when was the last time copper was up 10% a day and Microsoft was down 10% a day? And it pretty much, we went back to the 80s. We couldn't find a day that extreme. And it's pretty rare because you're talking about the second largest stock in the S&P 500 by the composition of the index. So, you know, that, that kind of migration of capital out of the United States, out of growth stocks into other types of equities, global value, that's a big, big shock. And it's a big, big transition that's kicking off in the market right now. We've seen this before with the dot-com era, and then you saw this with the oil and gas companies from 2010 to 2014, when there's an explosion of capital expenditures, trillions of dollars, right? We've already done $1 trillion of CapEx. Wall Street's expecting another 1.5 trillion over the next 2 years. And so what's happening today with Microsoft, if you look at their earnings, they are not generating enough return on capital. It's a shock. And it's really a potential massive reconstruction of the S&P, because when you have a group of companies that are spending this much and there's no visibility on return on invested capital, that is starting to scare people. You look at the performance of Meta, Microsoft, you look at the performance of a lot of the Mag 7 stocks the last like 6 months, that is shocking people. Yeah, so it's not going to be exactly like the dot-com bust, and it's not going to be exactly like the over expenditures and capital expenditures in the oil and gas industry from 2010 to 2014. We talk about that in our book, but it's similar. When you put forth that kind of investment, it's very hard to get it back in terms of like, what's your return on this investment? It's almost like a testosterone fight where everyone's flexing their muscles in Silicon Valley, and everyone wants to be first, and everyone thinks if you're not first, you're going to be last. But it's that kind of testosterone spending without any return on invested capital that threat is now starting to shock the market.
This is really interesting because I think at the core of this are valuations, right? And as a CPA and as a former auditor, it makes me wonder if so many of these new companies are entering the market and Basically, you just kind of have to slap AI on your firm, and you're this AI startup that's possibly going to, you know, may be profitable, it may not be profitable, but what's driving these fantastic valuations in the AI space right now, where there's just so much discussion already about these valuations not being really tied to, like you said, return on investment, or even the possibility of the industry in the short term overcoming all of those challenges that it's facing right now that are related to towns and cities and communities not wanting to have a new like AI center, right, built next to them.
Yeah,
So there's so many issues, and yet we still see these valuations skyrocketing.
right. And we have seen skyrocketing for sure, but we're also seeing big shifts within. So it's like an awakening period where Nvidia is still pretty close to the all-time highs,
Mhm.
but in a sense, this whole thing with memory, right? So look at Micron. So Micron's trading at the highest percentage above its 200 moving average, 200-day moving average all time. And so the cost of memory is skyrocketing, right? And that means that the capital expenditures of, say, Microsoft and these companies like Meta, their costs are going up because when they buy those chips, that memory cost is like up well over 100% in recent months. So that's creating this like, oh, you've got to invest even more money, right? So a lot of
Yeah.
times with commodities like DRAM and memory, the higher prices actually create lower prices because they crush demand.
Mhm.
So what's coming at us right now, this is the big shock. This is why we're gonna have a crash in the market, is that you have so much wealth that's concentrated in AI stocks, like you said, 35% of the S&P. You have this NIMBY risk, not in my backyard, not in my backyard. And then you have this whole problem with memory, right? Where the costs of those investments, the memory costs are exploding because AI process in those data centers, they need more and more memory for what's called inference. And that's so there's the first stage of AI is learning, then the later stages of AI, what's called inference. And inference requires a ton of memory. And so Wall Street is now bullish on these semiconductor stocks, but the bullishness of say Micron is bearish for a lot of it might be I think it's gonna be very bearish for Nvidia because once the growth slows down, Wall Street's expecting 820 data centers over the next 5 years. So if you have not my backyard risk, and then you have this risk from okay, memory costs have exploded, and that's going to slow down growth because once again, in a commodity market, high prices kill demand, right? That's the way the market works. And then you have this whole logistical problem about power and getting power to the data centers. So it's like three or four things that are going on. So you've got massive investment, everyone's crowded in the same trade, and these now these challenges are starting to appear. That's why what we've been recommending is positioning your capital in natural gas equities, coal equities, energy infrastructure plays that will support AI. Because at the end of the day, everyone's in the chips and no one's in the energy infrastructure to support all those chips.